Hello and welcome back to yet another pop-up live event where we unpack passive investing, due diligence, multifamily underwriting, and diligent investing, one step at a time. So, when sponsors took bridge debt during the boom, they faced a fork. And that is what I want to dive into during today's pop up live. But before we begin, for those who may be tuning in, for the first time or meeting me for the first time, my name is Vessi Kapulian. I spent most of my career in risk management and underwriting, working with founder led enterprises. And today I have my own firm where I advise family offices, their family enterprises at the board level. I also work with private investors on due diligence for those willing to do a deeper dive specifically into underwriting and basically helping them with education and guidance so they can become more empowered and educated investors. So, the fork that I mentioned at the beginning of today's live event and the topic that I want to dive deeper into is interest rate caps. So, just to take a step back for those who may not be familiar with the concept, a rate cap is you can think of it as an insurance product that effectively limits how much a floating rate on the loan interest rates can rise above a certain level. So there is an index and it basically caps how high that index rate can go up. And it's just one of many forms of derivatives, specifically interest rate derivatives. Again, the cap is one of the most commonly used, particularly in a situation where the lender is not able to offer a straight fixed rate option, or they don't have ability, or the borrower doesn't have ability to enter into alternative arrangements such as swaps, right? Their collars, caps, forward starting swaps and whatnot. There are a ton of derivatives, but the interest rate cap is the one that's most commonly used in the situation that I discussed. So effectively what happens is the borrower pays an upfront premium to have that option. And in exchange, if the rates rise above the cap strike price, then the cap effectively pays the difference. And it's effectively designed to hedge the interest rate sensitivity and protect exactly in during a scenario that played out in 2022 and onward. Now, caps cost money, right? There is an upfront payment that needs to take place, and a typical cost for a rate cap back in 2021 may have been 30 to 80,000 a year, or for 1 or 2 year term, again depending on the strike price, depending on the loan size, depending on the tenor. And I, by the way, as a side comment, I previously published an article that discusses this in a little bit more detail and how caps, swaps, and some of these hedge instruments work. So if you like to get a copy, simply message me in the comments and I will share with you the link. And so that was the premise of it. And again, the cost was real at that time, but it wasn't catastrophic. Nothing that couldn't be budgeted for upfront. And so at that time, to the extent the fixed rate option was not available and sponsors were looking to mitigate the exposure, some bought them, some did not, thinking that they would uh, likely benefit from even lower rate, and definitely willing to take the risk, but certainly not willing to bear the cost. And I'll come to that point in just a second. And so sponsors who did not buy the caps fell into roughly, I would say, three categories. So the first category looked at the cost and basically decided that the premium was not worth it because rates would stay low. The Fed has signal accommodative policy, right? At that time, the mantra was inflation is transitory. The 10-year treasury was below 2%. The cost of the cap felt like buying insurance against a fire in the building made out of concrete. And so it was basically deemed unnecessary. The second category bought the cheapest possible cap with maybe the highest strike, treating the purchase as a formality. And the cap technically existed on paper, but really did not provide meaningful protection at the strike rates that were reached eventually. And then the third category bought maybe a 1 year cap when the loan was, say, 3 years with 2 year extension, betting that they could possibly renew at more favorable pricing in year 2 or 3, so choosing not to get locked in. And when year 2 arrived, unfortunately, by that time and what transpired during that period, cap pricing had shifted tenfold or more. The renewal premium, in some cases, for something that would have cost, say, 40,000 in 2021, became 400,000 or even 1.5, 2 million in 2023. And a lot of that was predicated on the interest rate volatility during that period of time, and then how high the premium is depends again on the strike price, on the notional amount, and then the tenor that is being locked in. And so by mid 2023, the rate cap market itself became a crisis inside the broader debt crisis, let alone, of course, lenders were seeing that. And so many also started asking operators to start escrowing funds to ensure that they have adequate liquidity to purchase a rate cap at the time of the loan renewal. And so sponsors whose original caps were expiring faced renewed premiums that exceeded the loan's annual cash flow. Some sponsors, unfortunately, walked away from properties because the cap renewal cost was more than the equity remaining in the deal. And again, it wasn't the cap alone, there were other issues leading to that valuation compression that I've covered in more detail and I'll actually touch upon during the series that I'm having over the next 2 weeks. But the lesson here is not that rate caps should always be bought. The lesson is actually slightly more uncomfortable because the fork was a test on how a sponsor really thought about tail risk. A decision to buy or skip a cap really reflected the sponsor's underlying view of the probability, scenario planning, and the cost of being wrong. A sponsor who chose not to buy a cap was effectively stating, or they were implying, that I think the probability of rates rising significantly is low enough that the premium is not worth the protection. And then a sponsor who bought a strike too high was effectively stating, I'm buying insurance for compliance purposes, so I can get this loan through, but not really for protection. And then the third group is a sponsor who bought a real cap covering the full notional, the full loan tenor with a reasonable strike, thinking that, hey, rates may stay low, but if they do not, I want my LPs and my balance sheet to survive that possible scenario. And so the third sponsor type was really thinking about durability, positioning the deal for durability, whereas the first two groups that I mentioned were really focused on returns, whether realizable or not. So when you evaluate a sponsor today, you can no longer ask whether they bought a cap during the boom. The cycle has already revealed that answer, and there's been plenty of press about it. What you can ask is how they think about tail risk going forward. And the answer will tell you whether the lesson they took from the cycle was the right one. So I will leave you with one question. What does a sponsor's approach to tail risk look like in the deals you are seeing now? And if you haven't thought about it or haven't asked that question, I will leave you with it so you can add it to your toolbox and think about it next time you evaluate an investment opportunity. Now, this was a part of my 15 days series that I'm running. That will culminate on July 11th at 11 a.m. Something I've been working on for investors who think about durability and not just returns is arriving in the next 2 weeks. So if you'd like to be notified, or even if you simply want to follow the series with the lessons learned, I encourage you to subscribe, whether you're watching on YouTube or LinkedIn. And this way, you will be notified of future updates and will not miss future live events. So I wish you a beautiful day, a blessed weekend, and I will see you next week. I usually pop up Thursday or Friday afternoon for a few minutes, and I look forward to welcoming you at the next one.